A warm welcome to everyone and welcome to this demo session for the Quantitative Risk and Finance program. And this is for the July 2026 batch. The agenda for today's demo session is we'll do a walkthrough of the program so we'll understand what the program is and the main modules and how exactly we approach them as well. Of course, before that, we'll do a quick faculty introduction. So I'll introduce myself. Professor Date has joined in as well, so he'll also introduce himself. Dr. Lakshmi couldn't join in today, but I'll introduce him. So I have his profile enlisted as a part of this PPT. Uh, of course, we'll be doing a full-fledged demo class. So we'll take one topic and we'll do a discussion so that you have an idea as to how the actual interactive sessions happen. And let's keep the session interactive so that, and feel free to ask questions. So you can either unmute and ask, or you can put it in the chat box and ask as well. So that way, so you'll get a feel of the real classroom, and we promote interactive learning. So I think that's the best way to learn. So briefly talking about the QRFP, of course, I'll do the walkthrough as well, but then just a quick brief on this. So QRFP is a professional qualification in quant finance and risk analytics, and the program has been carefully designed to meet the contemporary industry requirements. Now, our candidates who have completed the QRFP in the past have found these skill sets very, very applicable to the industry. So this program is for the practitioner, so that we can definitely apply this across global job roles. And the main program modules which we cover, which I'll anyways walk through in detail, we'll have financial mathematics. We will do quantitative modeling across asset classes, market risk, counterparty risk. We'll have credit risk. We do a lot of modeling in Python. So Python remains our mainstay when it comes to modeling. We use Excel for smaller calculations, but any meaningful modeling will happen in Python only. And then, of course, applications of machine learning and AI for finance. And a quick snapshot about the batch details. So this is the sixth batch of the program. We begin from 18th of July with sessions happening on weekends, just like this one, like the live session. Of course, we start a little earlier. Since it's a demo, we are starting a little late today. Of course, there are primers which are ready as well. So primers are the foundational material which are pre-recorded and which are accessible from the portal. So that way candidates who have signed up have started studying them already. So I'll walk you through the contents which you can expect as a part of the primer also. The QRFP will help one prepare for very, very interesting and dynamic job roles across the world, I would say, because then, to be honest, quant finance is applied mathematics, and you can apply these concepts across the globe. Maybe the market dynamics change a little bit, but otherwise, conceptually, the same things can be applied across different markets. And the main roles which one can gun for will be quantitative model development, model validations, derivatives pricing, core risk management profiles, treasury analytics. Of course, data scientists who would like to work on quant finance projects will find this course useful as well. It's extensively useful for consulting as well. So that way, if you're a part of these large consulting firms who are working with multiple clients, these kind of skills will come very useful on their projects. And also, it's useful for portfolio managers or even front office desk quants, etc. So this may not be an exhaustive list, but this gives you a gist of the roles which this course prepares you for. Now, let me introduce myself. So my name is Amir. I will be one of the faculties for the program. And my background is, so I come from the industry. So I've been in financial services for close to 17 years. So I was working full time right until 2020. And so that's when, after that, I set up FinQuest Institute, and we have been in operations for more than 5 years now. We focus our training programs on risk analytics, quant finance. We also help candidates train for FRM, and we do career counseling services for students and working professionals, typically those who want to get into financial services. I continue with my consulting work as well. So we do it under a separate trade name, and typically the consulting engagements which I work is related to the things which I worked in the past. So be it model development, model validations, or process reengineering, funds transfer pricing, and so on. And my previous experience is a mix of banking and consulting. And academically, I'm a CFA, a CQF, an MBA in finance, and an engineering graduate. And I've been teaching for some time now. So even while working full time, I used to go as a visiting faculty to a few places, and those associations continue. So I have a long-standing association with Wellington Institute of Management in Mumbai, Gokhale Institute of Economics in Pune. I am attached to XLRI in Delhi NCR as well. So these are trimester commitments for specific subjects like fixed income, financial analytics, financial risk management, and so on. And I work closely with a couple of private universities in India as well. So I'm a part of their academic council. So they have nominated me as an industry consultant on the board of studies and academic council to help them design curriculums which are in line with the current industry requirements. And I like to write a lot as well. My focus areas remain quant finance, capital markets, and technologies for finance in general. So this is a brief about me. So I see Professor Date has joined in as well. So Date sir, welcome. And if you would like to walk through your profile, it would be wonderful.
Thank you, Ameya. So, my name is Paresh Date. I did my PhD in engineering a very, very long time ago. I have been working in financial mathematics for last 20 odd years, both as academic as well as a consultant. So, I have run consultancy courses in UK as well as in India. I have supervised lots of PhD students, 12 PhD students to completion, mainly in the area of quant finance. I have taught quant finance in India as well. Well, I have been teaching it in UK for a long time, both at MSc and at undergrad level. And I have taught at IIT Gandhinagar, IIT Patna, and more than a decade ago at IIM Kolkata. So that's me. I bring both academic and partly industry perspective through consultancy experience as well as through experience of my PhD students who have finished and are working as quants and act as industry advisors to my department in Brunel University of London. And I have been working with Ameya for now for a long time. I mean, we know each other since before he started
Yeah,
his own company, and he was
2014.
still yes.
Yeah.
So indeed, that makes me feel very old, Ameya. But yes, so for really a long time. Um, and I have been associated with this program with QRFP since its inception. So there is an R there. That's a serious R. QRFP is indeed a registered trademark. Um, so yes, I will be involved in the program, and you're very welcome to contact me via LinkedIn or via my homepage. So my university knows that I'm involved in this program, or from my personal email, and I'll be teaching fixed income later in the course. So I'll hand back to Ameya unless somebody had some comment for me.
Oh, yeah. Thank you, Professor Date. And as I mentioned, there'll be one more faculty, Dr. Lakshmi Narasimhan. So Lakshmi couldn't join in today because of his work commitments. But then Lakshmi is closely associated with the program as well. And he is working as a partner with a leading consulting firm. And he has more than 2 decades of experience, mainly in model risk management and risk consulting in general. He brings a wealth of experience across clientele and across markets. So he has his teams working in India as well as in London as well. And he specializes in core credit risk modeling. So Lakshmi looks at things like PD, LGD, EAD modeling, scorecard designing, and those core concepts which go into core credit risk management. So Lakshmi will be the faculty for that. So it will be the three of us, me, Dr. Date, and Dr. Lakshmi. So let me do a curriculum walkthrough. I know some of you might have already gone through the course file, which is uploaded on the course page, but then I will walk you through that as well. So maybe in the next 10 minutes, let me do a walkthrough of the course syllabus. And after that, we'll begin with our demo class, if that's okay. So let me switch screen and I will walk you through the course file. So this is exactly the same course file which you will get to see on the website as well. So you can go through the earlier pages. So things like, I mean, the history of the program and how it has benefited our candidates and the student testimonials and those details. So everything is there as a part of these initial pages. And I welcome you to go through this later on. Maybe later on, I'll just drop an email to everyone with the course file so that, of course, you can download it from the website, but it will be easier to have it on email as well. So I will send this across and you can have a look at this. So let me scroll to the meat on the bone and we can begin with the discussion. So to give you an overview of the course, and we do this in like 10 minutes time. So as I mentioned, there are primers. So primers are pre-recorded videos on maths, Python, and foundational finance. And the main idea behind why these primers are designed is it helps candidates brush up or build the required amount of foundational material which we can start consuming as a part of the main course. So there may be many concepts, particularly I would say maths. Now, of course, we have a few candidates as a part of the session today who are mathematicians. So I mean they'll be familiar with this. But then I would say uh, many a times it happens that we might have learned a lot of these maths concepts, particularly in the past. But then, unfortunately, we don't get a chance to use them. We lose touch and we tend to forget things. So that way, don't worry about it because then the maths primer starts from the bare basics. It starts from the number system, basics of functions, limits, continuity, Taylor series. Uh, we'll have integration, introduction to differentiation, etc. We also cover probability as well because then probabilities form a very, very important building block as a part of overall quant analytics in general. So different types of probability distributions, what is discrete, what is continuous, and of course, center limit theorem and how exactly we use that as a part of our modeling exercises, something which we'll discuss in further detail in the live sessions. We have a module on linear algebra as well. So particularly focusing on matrices, vectors and their properties, and also eigenvalues, eigenvectors, and so on. Now, the main idea behind why the linear algebra portion is included is that comes very useful typically for two things. One is for portfolio optimization modules. So whereby we try to understand, let's say if you're working on a maxima or a minima kind of a requirement, let's say we want to maximize returns of a portfolio or minimize risk. So there are a couple of conditions which we apply, and that is something which you can efficiently handle through matrices. The next is also as a part of big data analytics in general, which includes AI, machine learning, everything. Usage of linear algebra, particularly matrices, is very, very heavy because then handling large amount of data is very convenient through matrices. So that's why the primer portion on the linear algebra part. We have a Python primer as well. So some of you might have worked on Python in the past, but then for others who might not have done programming in the past, don't worry, because then, to be honest, Python is not a difficult language to learn. And the basic ideas of Python, like what is Python, loops, data types, conditional statements, some basic definition of libraries, that is something which we cover as a part of the primer. So that once we start using Python more mainstream as a part of the modeling work in the main course, you are very, very comfortable. And we'll be doing a lot of modeling together. So for our friends who might not have done programming in the past, I'll say do not stress. Maybe once we do a few models together in the first few weeks, you'll get a lot of confidence and comfort on Python. Of course, there are assignments as well, which will allow you to do further practice on Python along the way. And we have a finance primer as well, typically covering the basic ideas of capital markets or what's the difference between a cash and a derivative segment, definitions of NPV, IRR, typically studied under TVM, and some basic definition of what's a forward contract, what's an interest rate swap, and so on. So that way, these primers are already ready and they are accessible. So they are uploaded on the student portal, and candidates who join in, they start studying the primers immediately. And that way, the primers stay on the student portal. So even at a later point, if you have to go back and revise a few things, that is always doable. But then we always recommend candidates that go through the primers at least once before the live sessions begin. Because then the idea is in the live sessions, we'll be building on top of this and learning some more interesting concepts. So having good hold of primers is very, very useful and important. And also what we have done is as a part of the primers, for each of them, we have a small questionnaire or like a hands-on exercise which has been given on the student portal. So that way it gives candidates a chance to practice things on their own once they go through each of these primers. So you can think of this like a one-stop solution for building all of your foundational materials. Then we begin with the live sessions. As I mentioned, live sessions happen on weekends. And so initially, I would say for the first couple of weekends, we will not require a lot of maths as such. That consumption begins once we are into weekend 3. So we begin with the fundamentals of risk management because then knowing how exactly the risk function works in a bank or a lending institution, also the important roles and responsibilities, risk governance, Also having a flavor of risk appetite framework and risk statement. That is something which you do as a part of this initial module. So it's like a warm up to how exactly the risk function fits in the overall framework of an organization. Then we do bond mathematics because bonds are very, very fundamental for anything which we study in quant finance. So particularly things which we study as a part of Date's sessions as well, whereby he focuses on rates modeling and other interesting concepts like interest rate derivatives and so on. This good understanding of bonds comes immensely useful. So we have things like definition of bonds, yield and spread analysis. We do rates analytics, including bootstrapping in order to extract zero rates, extracting forward rates. How do you measure risk sensitivity like duration, convexity, PV01, and so on? We also touch upon bonds which have optionalities, callable and puttable bonds as well. And wherever you see hands-on exercises, all of these things are done in Python. And we'll be doing a few things together and some things that I'll give as a homework. So when I say homework, we of course discuss the approach first and then you can give it a go. So homework generally on the Python part begins after about three odd weeks. So that way, once we have done a few things together, it gives confidence for candidates to start trying a few things at their end. Then we touch upon futures. Although futures is an easy topic, it's important because typically if you're looking at, let's say, an NBFC in particular, I'll say, they use this extensively for their hedging. So that way, I mean, things like definition of futures contract, cash and carry and reverse cash and carry arbitrage. What do you mean by basis risk? What do you mean by cross hedging? How exactly you can use futures in order to change, let's say, beta of an equity portfolio or duration of a bond portfolio. That is something which we discuss together as well. Then we get on with options. So we understand options theory, the very, very fundamental put call parity, also connecting it with the idea of no arbitraging. We cover few important option trading strategies. Now, this point comes very, very useful, the option trading strategies part, because then we'll have a separate module on volatilities, whereby we understand Wall smiles and other concepts. So that's where these typical strategies like, let's say, the straddle, the strangle, the butterfly, risk reversal, they come immensely useful. So we cover those things before we get on with smile analysis. Then we begin with the discrete time model first. So that way, if you see point number 3 talks about the binomial model. So binomial model is a very, very popular model when it comes to discrete time option pricing. And why we always prefer to do this first is because the best part of the binomial model is you can draw it on a piece of paper. You can actually show it as a picture. And that way, once we see that picture, we begin understanding a lot of concepts very clearly. Unfortunately, the continuous models, we can't show it through a picture like we can do for a binomial model. So we always focus on the binomial model first and understanding the fundamental concepts of risk neutrality, delta hedging or no arbitraging concept which we try to apply. We also understand what's the meaning of model calibration. So we will do calibration for both the binomial tree, we'll do it for Black-Scholes. Professor Date covers calibration as a part of interest rate derivatives as well. And binomial trees are very, very flexible. So later on, you'll see there's something on ESOPs as well. So as a part of this module 3, we try to apply this for European and American options both. Then between the discrete time system, which is the binomial model, and then if you see there's a mention of Black-Scholes, right? There is a very, very important bridge which we try to construct, which is module 4, which is stochastic processes. So I'll say it's a very key component of the overall program. And a good understanding of stochastic processes 1, 2, and 3 plays a very significant role to understand all of the things which we study later on. So we start from the bare basics. So we understand the random behavior in financial assets. We try to link it with the idea of diffusive processes. We try to understand how we can link it with, let's say, a financial asset like equity or FX, etc. We understand the concept of the Brownian motion. We take different forms of ethos. So when I say ethos, think of these as different formulations which you can apply to different functional forms. Now, I'll not go into too much of in-depth maths today because then it's a demo class and we have not done all of these things before, isn't it? So that way, today's session, I'll try to keep it maths light, but then believe me that once we begin with the live sessions, we start digging a lot deeper. So for our friends who might not have gone through this file in the past, or maybe who might not have worked on stochastic processes, please do not stress, because then these words, when you read them for the first time, they appear as if they are very, very difficult. But believe me, we are going to study this in a very, very systematic manner, and it doesn't become difficult to digest after that. And the modules have been put together in such a way that it's like a gradual step up. So at no point in time will you feel that we have made a jump across something. So even if some terms appear challenging, I'll say do not stress. We'll be studying that together and we'll understand everything. Yeah, so we study Ito's lemma. We try to understand ideas of correlated processes because then we can have certain financial products which are linked to, let's say, two assets. So then the correlation between two assets becomes important. We also touch upon the ideas of martingales because then it's a very, very important construct which can be applied for quant finance in general. So understanding the ideas of Ito's integral and different properties like Ito's isometry, and there is an equivalence between things which you study in stochastic processes part 2 and part 3 through the ideas of equivalence between a martingale and a SD. So when we say SDA, it stands for a stochastic differential equation. So today I will show you one very simple stochastic differential equation. So I'll keep it very simple, but I'll show you how it looks. Then we have the Black-Scholes-Merton, a very, very popular model. I would say arguably the most popular model in quant finance, and almost everyone has heard about it. So then what's the Black-Scholes PD, how you derive the PD, how you solve the PD to arrive at the closed form solutions, different conditions which you try to apply when you try to solve the PD. Also different kind of enhancements which are done on top of the Black-Scholes-Merton framework. That is something which we do as well. We will study calibration of this model to the market. So I've been talking of the word calibration a lot, isn't it? So maybe when we talk of the demo class today, I'll touch upon the basic idea of model calibration. So some of you might have heard this term in the past, but since calibration is mentioned at a few points, I'll talk about briefly as a part of our today's class. We'll have option Greeks, very, very important risk sensitivity parameters. We understand how they're measured and how they're managed by a typical risk desk. We have a module on ESOPs and warrants because typically for our friends who work in or who would be gunning for working in an IPV profile, which we call as independent price verification, you get a lot of clients who have ESOPs on their books and they want a fair valuation of that. So at that time, what kind of models can be applied for ESOP valuation? How do you factor in different conditions like employee churning or employee retention, and how exactly the vesting period gets accounted, etc. All of those details we can incorporate as a part of the model. We study that together. We'll have numerical methods, a very detailed module which talks about three important types of numerical schemes, which is trees, finite differencing, and Monte Carlo. So numerical methods are very, very commonly used in quant finance because then there are very few problems in quant finance whereby we have a closed form formula. When I say a closed form formula, think of it as if it's a formula whereby you simply plug in the things on the right hand side and you get the answer on the left hand side. So, but those are very few in number. Most of the times we have to apply some kind of a numerical scheme in order to arrive at a solution for a problem. So how do you work on numerical methods and how do you also implement them? That is something which we do together as well. Also from the last cohort, what I started was we do one revision class on applied maths, and we generally do this after about 9 weekends of the cohort, because then we have covered a lot of financial mathematics in the first 8 to 9 weekends. So then it's always a good idea to do a revision class. So then we do 2 extra classes which are over and above what we do on weekends. So these happen on weekdays and we mutually decide a time. So I just request candidates that I will require 2 days of your commitment and we'll take like 2-hour sessions after office hours so that we can do a full revision of the entire applied maths which you have studied. Now, the advantage for this is the revision class comes useful not just for the remaining part of the cohort, but I'll say for any kind of things which you work later on as well. So that's why we will continue doing this revision class this time as well. Then there are different ways in which one can work on Black-Scholes-Merton. So we understand the partial differential equation way on module number 5. In this module, we touch upon how we can solve the Black-Scholes-Merton through the martingales approach. So martingales are very, very interesting. They have their grounding in probability theory. And what are martingales? How do you solve them? That is something which we will study together. We have a module on portfolio optimization. So understanding right from the ideas of modern portfolio theory and investment policy statement, then how you can actually build on all of these concepts and do things like constraint optimization. So things like Lagrange principles and how do you calculate, let's say, the gradient and the ACR operator. So these are like two conditions which you require as a part of optimization exercise. So we do those things together. We do a lot of hands-on on these as well. Then we'll have market risk management through value at risk and conditional VAR, two very, very important metrics which are used in risk management. And I would say they are very popular across industries, and industry participants use this almost every day. So what they are, how do you calculate that? How do you backtest them? That is something which we'll study together also. Module 12 talks about volatilities. So, of course, before this, if you recollect, in the initial module, I had mentioned that we will be studying those important concepts on vol trading strategies, isn't it? So, those are something which we start using this as a part of module 12. So, things like straddles, triangles, butterflies, etc. Those get used a lot, especially as a part of smile analysis and smile construction. How they are used, how you can build a smile, and maybe going ahead, how do you build a wall surface? That is something which we study together. We also do local volatility models. So many times, and you will hear the word deterministic walls. So at times so deterministic walls and local walls. So those are like two very similar sounding terminologies. So we do local wall models, particularly focusing on the Dupar model's workings. We'll do the parametric models as well. Although simple, they are very popular. So things like GARCH or EWMA, etc. We will do stochastic volatility, particularly focusing on the Heston model, how you can calibrate it to the market. Those kind of things will be studied. Also, we have 1 weekend of scheduled mid-course break. So generally, we do this around weekend 10 or weekend 11. And this scheduled break is something which gives a candidate to complete on any assignments which are pending, also revise concepts, and also they get time to relax as well. So that way, this 1 weekend mid-course break is like a scheduled break, which we take around weekend 11 or weekend 12, I would say. Then we come back and we touch upon the ideas of regulations. I know regulations can be a huge topic. So, of course, we cannot have a separate, and we'll do this to a limited extent, because then if you have to study regulations in detail, it can become like a separate 30 to 40-hour topic as well. But then we will cover the main aspects like FRTB, Basel III, and how do you calculate a capital charge under these. Now, why this module is there is because in many of the interviews, it's expected that candidates are at least familiar with these kind of concepts. So, so that way, this module on regulations comes useful. We discuss model risk management. So, earlier we used to cover SR 11.7 guidelines, which are very popular model risk management guidelines which we use in the industry. Now, we'll also touch upon SR 26.2, which is like an enhancement on SR 11.7. So, that is something which will be covered. Then module 15, interstate derivatives and interstate modeling. This will be covered entirely by Dr. Date. So things like interstate derivatives, interstate modeling, including Hull and White, Cox-Ingersoll-Ross, Vasicek, all of these things Date sir covers. Then module 16 will be covered by Dr. Lakshmi. So PD, LGD, EAD modeling, credit scorecards, model validation in practice. All of these things are Lakshmi's forte, and he'll be covering these concepts. Then we talk of economic capital as well. We are almost nearing to the end of the file, so just bear with me. We'll do economic capital because sure, I mean, regulatory capital is something which you study as a part of the module on regulations, right? So as a part of module 13. But then here, economic capital is also very, very important, because then things like unexpected losses, which typically a bank wants to model and manage, that is something which is covered under the idea of economic capital. And how exactly economic capital is linked with the ideas of bank ratings, etc. All of those things will be studied. Things like maybe the unexpected loss contribution of different loan positions and so on. So all of these things will be covered. We'll have credit derivatives. So we understand both. We'll understand the Mertens model. We'll understand the intensity model. So these are things which you do first. And then we expand on that in order to understand credit default swaps, how you can use the CDS data in order to extract what we call as survival probabilities from the market, and a few other types of credit derivatives, the popular ones, first to default put or a credit linked note. That is something which we attempt to cover as well. We'll, of course, do a valuation for a few of them also. Then we have counterparty risk. So things like risk exposures and how do you measure counterparty risk limits, etc. That is something which we study as well. I think as a part of the earlier one, I'm not sure if it's mentioned, but we'll also touch upon the ideas of joint probabilities of default, something which we call as the copulas. We typically focus on Gaussian copulas, which are very, very popular to understand how correlated default events are modeled. So that is something which you do as a part of the credit risk modeling modules as well. We touch upon CCPs or central counterparties, very, very important for ensuring the guarantee of clearing and settlement of transactions. Module 20 talks about CVA, DVA, and wrong way risk. So these are typical adjustments which are done by banks as a part of their overall XVA desk as such. So we won't do the entire XVA as such, but we'll focus on these three ideas. And then the last module talks about using deep learning, machine learning, and AI for financial applications. So right from the ideas of supervised, unsupervised reinforcement learning, then building blocks like mean variance, bias or trade-off, then also things like gradient descent or what we call as optimization, and different types of deep learning models, typically focusing on things like LSTM, which are very common amongst industry participants, trying to understand natural language processing, how they can be applied, let's say, for something like news sentiment analysis, something which dealers use as a part of trading decision making as well. And we also focus on certain AI applications for finance, along with a hands-on for a few. And as a part of the assessments, there is regular assessments which we do. So that way, when I say an assessment, it's like an assignment which can either be applied maths or it can be hands-on Python. And that is something which candidates can practice, and that gives them confidence on the concept which you have studied in class. There is an end of the course project as well, which is like a culmination of things which we study along the way. We try to pick 3-4 topics which are relevant to the contemporary markets, and candidates can pick any one and they can implement that project. So that way, the advantage is these kind of projects you can show on your CV as well, and because then they are relevant to the current markets and it becomes very useful to show on one's resume. And we have a separate add-on modules section which we keep flexible. So this we add towards the end. So certain things over and above the course curriculum, like maybe operational risk management or maybe parallel computing or time series analysis, which you don't cover as a part of the curriculum, that is something which you put as a part of the add-on module. So this is a very flexible add-on module section, I'll say, and we keep on adding things into this. Yeah, so this is the entire course file as such. So any thoughts, any questions which anyone have which I should go through before we can begin with our demo class? Of course, you can go through the course file later on as well again, and then we could again touch base if you have any specific questions subsequently as well. Yeah. All right, so let me go back and we will begin with our demo session, shall we? So we will do something on options, particularly on, yeah, I think there's something in the chat. Yes, absolutely, Narendra. So everything which we discuss in the class, that gets recorded and that gets posted on the students portal. And that can be accessed from your phones, laptops, everywhere. So that way, in case, even if you do miss a certain class, let's say you're traveling, you won't actually miss anything. That will be there as a part of the recording. So everything will be there. Yes. All right, so we will do something on options. I know a few of our friends who come from the industry or who have worked on risk. They might have worked on options in the past as well. But then this slide is particularly for our friends who may not have worked on options, so that because we'll be doing something on Black-Scholes Merton today. Thanks, Narendra. So we will be doing something on Black-Scholes because then it's a very popular options pricing model. We'll try to understand some maths behind it. But before we do that, a brief overview of options will be very, very useful. Now, so for our friends who have not worked on options, I'll try to keep this very simple and I'll explain you what the idea of an option is. So that when you say an option, it is a derivative contract. And when you say a derivative contract, the idea is when something is a derivative, it is going to derive its value from some underlying asset. So that way, let's say if my underlying asset is a equity stock, then I can have a derivative which sits on top of this. And the movement in the underlying asset will have an impact on the price of the derivative as well. And that's why the name is derivative, because it's deriving its value from some underlying asset. Now, typically when you talk from options, right, the two parties which are there to the option, they are given specific names. So if you see the definition, which you can read through, right, so it talks about a right and an obligation. So these two words are important. So I'll show this through a very simple example so that we understand what the structure is. And If you allow me, can I just switch to the whiteboard? I just do a small working there. And I'll try to keep it very, very light on the technical aspects, because then I appreciate that some of our friends today might not have worked on options. So let's keep it simple for everyone. Now, let's say that I'm a buyer. Yeah. So let's say this is me. And let's say I want to buy a really good quality wristwatch. Let's say this is what I want to purchase. Let's say I want to buy it for myself, or I want to gift it to someone, etc. And let's say the wristwatch is currently available at $100. But my condition is I don't want to buy the wristwatch immediately. Let's say my birthday is coming in 1 month's time, and I would like to buy this wristwatch after 1 month. But then I am concerned that the demand for wristwatch, this particular brand, is very, very high. And I'm concerned that the wristwatch can become expensive in 1 month's time. And let's imagine that my maximum budget, which I can spend on this wristwatch, is only $100. I cannot spend even $1 extra. So then what I can do is I can approach, let's say, the seller who is actually making the wristwatch. Let's say I go to the manufacturer and I tell them, I really love your product a lot, just that I don't want to buy this product immediately. I want to buy it in 1 month's time. And can we have a contract such that we freeze on the price of $100 today? I.e., and the contract looks in this way, that in 1 month's time, I have the right but no obligation to buy this wristwatch at $100. So let me write it here. So if you see, and imagine that the manufacturer agrees to this contract. Yeah. So I become what you call as the buyer or the holder of the option. And then the wristwatch manufacturer, they become the seller of the option. Yeah. And as per the definition, the buyer of the option has a right and no obligation. I will tell you the meaning of this through a simple scenario analysis, or I'll take one example and explain that simply. Whereas an option seller, they only have obligations. So I'll tell both of these scenarios or both of these definitions through an example. So let's say that me and the wristwatch manufacturer, we agree to this. So that means we have entered into an option contract with me as the buyer and the wristwatch as the seller. And what's the agreement? The agreement is that I am an option buyer. That is, I have purchased an option from the seller, and that gives me the right but no obligation to purchase the wristwatch at $100 in 1 month's time. So that's my contract. But now if you see, the wristwatch manufacturer says, hang on, I see that, you have all the flexibility, isn't it? So you say, yes, yes, absolutely, because then we can say no if we don't want to buy the wristwatch in 1 month's time. So they say, hang on, we are taking the entire risk, and then we should receive some compensation, isn't it? So we say, yes, that's fair enough. We have to compensate you. So that's why at t equal to 0, when we are doing the contract, the buyer, which is us, needs to pay what we call as an option premium to the seller. And this premium is paid in order to compensate the seller for the risk which they're taking. So you may ask me, where is the risk? Now, the risk is I have the right but no obligation to buy the wristwatch in 1 month's time. So that way I have a right to say no. So then if you see, the wristwatch manufacturer is taking a risk, isn't it? So they have to be compensated. So then that way, for all the risk which they bear, we pay them a premium. And that is something which you do at t equal to 0. So we sign on the contract, we go back to our homes, and then let's fast forward, and we are at t equal to 1 month. So we are at what we call as option expiry. And we take two scenarios. So I could either end up in scenario 1, or either I could end up in scenario 2. And let's say in scenario 1, this wristwatch is now available at $150 in the market. And in the second scenario, the wristwatch is available at $80. So then a quick question. If I end up in scenario 1, should I exercise my right for the option, or should I not? What do you feel? So how many feel that in scenario 1, I should exercise my option? Yes, anyone, you can give it a go. Let's keep it interactive. So even if you're wrong, it doesn't matter. But feel free to answer. Either you can unmute and answer, or you can put it in the chat and answer as well.
Scenario 1.
Correct. So scenario 1, we will exercise, right?
Yes, exactly. Yes.
Absolutely. Yeah. Lovely. Thanks, Vishal. Yeah. Yeah. Thanks, Vishal. Thanks, Narendra. Thanks, Bharat. Yes. So scenario 1, I definitely exercise. I'll tell you why. Because then if you see, it's profitable for me to exercise in scenario 1, because then everyone else in the market has to buy this wristwatch at 150 when I can buy it at 100. So I make money on this, isn't it? That is, I save money. I get to buy at a below market price and I profit from this. But on the other side, let's say I end up in scenario 2, I will not exercise. Why? Because then there's no point in paying $100 for something which I'm getting at $80 in the market. So in scenario 2, I will not exercise. So this is what we mean by exercising or not exercising the option. And then the premium which is paid, that is like a sunk cost anyway, because then that is something which I have paid at t equal to 0. So that cost is gone anyway. So then at option expiry, I make this decision whether I will exercise or not exercise. And this is how a very simple option contract works. So for our friends who have not studied options in the past, do you have any questions on this? Okay. So all of these points we have seen through a very convenient example. And I like to do a lot of working on the whiteboard because I think that gives a lot of clarity to things. So you'll see in the class as well, I extensively use the whiteboard. So buyer also called as a holder, seller also called as a writer. We know the idea of option premiums. Popular option types, we have call options and put options. There are different types. So these are the vanilla ones. There are barrier options and all those exotic stuff as well, which we won't touch about today, but we have a module on exotic options, which we cover in the live session. So we will touch upon all of those interesting products at that point. Options market is big. It trades everywhere on exchange as well as the OTC. The OTC market is much, much bigger as compared to the exchange. And you can have a lot of underlying assets which can act as the underlying security for the option. It can be stock prices, index prices, commodity prices, interest rates, etc. So any thoughts, any questions on this slide? So generally, even in the live session, what I do is after every couple of slides, I take questions, because then I don't like to keep the questions to the end, because then many times it happens that concepts are linked, isn't it? So I tell candidates that if you have a question, feel free to ask, because then maybe on slide number 3, there could be a connection to what you have done in slide number 1. So that connection, you'll be able to understand once those concepts are clear. Okay. Now, quick question. We will be doing Black-Scholes today, yes, but then Black-Scholes is also what we call as a typical options pricing model. So that's a model which allows you to calculate what's the value or the price of an option. So that's the modeling part, isn't it? But should we try to understand the motivation behind this? So can you think of a few reasons as to why people do option pricing? So let's say you use a Black-Scholes or a binomial or any other model, but you always try to figure out what's the option price. So why do people do options pricing? Can you think of applications whereby you can use these option pricing numbers for some decision making? So I have my list here. So once I press a space bar, all of this will appear. But I'd like to hear from you first. So why do we take so much effort to do option pricing? So I can start and you can join in. So I think option pricing can be used for trading purposes, trading decision making, whether you want to buy or sell something. Any other place whereby you feel options pricing will be useful? So feel free to give it a go.
To hedge the positions.
Absolutely. So can I say risk management in general? Yes, risk management. Absolutely. Good. Any more points? Any more places whereby you feel an option price will be required? So there's something in the chat. Let me go through. Yes, disclosure on financials. So Bharat, can I say in general, I'd say portfolio valuation plus regulatory reporting. So would that be okay, Bharat?
Yes.
Okay, okay, awesome. Any more points, guys? Any place whereby you feel that you calculate the option price and that will be consumed?
Ultimately, you want to know the cost associated.
Yes. So can I also link this from maybe a capital perspective as well?
Yeah.
Risk capital. Absolutely. Thank you. Yes. Yes. We will require this for stress testing because then it's a compliance requirement for banks. So as a part of stress testing, we will require option valuations. Dot, dot, dot. A lot more. So I think I've listed a few points. So there will be overlaps between what we have written here. Yeah. So daily portfolio valuation. Yes. We want to know where the money is at. We use it for risk management. So as one of you rightly said, we can use it for hedging purposes, and risk management you can apply it for both. Maybe you can do it through value at risk, or you can do it through Greeks as well. We use it for trading decision making, regulatory capital calculations, stress testing, reporting, both MIS reporting as well as external regulatory reporting. Counterparty exposure monitoring, typically called as the idea of limits. So there's a very interesting real-time limits module which is used. That is something which you study in detail in the live sessions as well. And also for daily collateral exchange. Dot, dot, dot. Many, many more. But actually, this gives us a motivation, isn't it? So that way, for every concept which we study, right, I always explain why we are doing something. Because then, unless we know the why part, we don't have the motivation to study that, isn't it? So I always like to understand why we are doing something, and I always insist that candidates should also understand why we are doing something, because the modeling part is the how part. How part is something anyways we'll study, but once we are motivated as to why we are doing and where our modeling will be consumed, that gives us a lot of motivation to apply these things in practice. And that's why the why part becomes important. Now, shall we do some discussion on Black-Scholes? I would say the most popular of the models, I would say, in quant finance in general. So Black-Scholes pattern is a Nobel Prize winning model, and it was founded by the three scientists back in 1973. It's extensively popular amongst industry participants, and it is relevant even in the contemporary markets. It is a continuous time model. So as I mentioned, there are two systems, right? A discrete time and a continuous time. So this is a continuous time model. To understand the Black-Scholes model, we need to have an idea of Ito's, what we call a stochastic calculus, delta hedging, no arbitrage, and so on. So today we'll keep it very light on the maths part. I have a few steps which are done, but we'll not do a formal calculation today as such. We'll do the in-depth calculation in the live sessions. In the demo, we only have limited depth which can cover. And also, typically, when we talk of any vanilla option, so remember the wristwatch example. So that can be thought of like a vanilla option. So a typical functional form for a vanilla option is given by this. I'll tell you what these variables are. So V is our option price. So one can think of this as the dependent and independent portion. So think of the left-hand side as the dependent variable, which you're trying to figure out. And on the right-hand side, you have the parameters which will drive the option price. So this is also what we call as the spot price, or if I take a stock, let's say the current stock price. K is the strike price. So if you remember the wristwatch example, I did not introduce that technical term strike price at that point. So remember that $100, which we had agreed with the wristwatch seller. So that was also what we call a strike price. So you agree to a strike price and then you have a contract. So every option will have a unique strike price defined as well, typically vanilla option. Then we have time to maturity. I just call it as TTM. R is, so for our friends who have studied options in the past, a question for them. For others who have not done options, don't stress about this. Or if you want to attempt, definitely give it a go. So what should be this R? So should it be the risk-free rate, or should it be the rate which is adjusted for some kind of a premium, etc.? What do you feel? It is risk-free. Yes, yes. So absolutely. So it is risk-free, and why it is risk-free is something which we'll understand as a part of our live sessions as well. For now, we just take this as a risk-free rate. So for our friends who might not have studied options, might have a natural question in mind that, I mean, hang on, options are risky assets, so why is this person talking of risk-free rate, isn't it? But bear with me, once we come to our live sessions, we will do an in-depth discussion as to why risk-free rate is the correct rate to use. So for now, we just take it as a given. And this sigma is the volatility. So these are the 5 parameters which will drive your option price. So this is also what we call as a functional form for option price. Now, if you ask me personally, I actually like to call the BSM model as a BSM framework. And it's for a reason, because then BSM is such a popular and a powerful model that once that framework is well understood and well studied, that is something which we can use in order to understand a lot of other advanced concepts as well. So that's why I personally prefer to call this as a BSM framework, which is, I feel, is much, much bigger or more as compared to a BSM model. Yeah. Uh, let's go through the standard assumptions which go into the Black-Scholes-Merton. So if you see the very first assumption, so these are the assumptions which were used as a part of the module formulation back in 1973 by the 3 scientists. So these are those old assumptions, but something which are still used in practice, of course, with certain enhancements. So the first one is the price of the underlying asset follows a log normal distribution. So a quick question for our friends who remember probabilities. What's the property of a log normal distribution which makes it like a good candidate for modeling of the underlying stock price? So when I say the stock price, think of this like a stock price. And we say that log normal distribution is something which we extensively use for modeling asset prices. Absolutely. Thanks, Bharat. Yes. So why we use log normality? Because then imagine that you're using a stock price as the underlying security. Then stock price cannot go negative, isn't it? And for that purpose, having a log normal distribution is very, very important. When you say log normal, it looks like this. It's a little skewed, but then it can be thought of as this way. It's grounded at 0. Then we have 2 more assumptions on constant risk-free rate and constant volatility. At times, it can appear to be a little restrictive, isn't it? So there are ways in which the market tries to enhance this. So there's a way in which you can make this more flexible. For now, we just take a constant risk-free rate and a constant volatility. No restriction on borrowing and lending, and they can be done at equal rates. The earlier model of Black-Scholes assumed no dividends were paid on the underlying stock, but then that can be enhanced as well. So these are the enhancements which can be handled. Yeah, Bharat, yes, I understood the typo. Yes, you meant it can't go negative. Yes, thank you. Markets are frictionless and no arbitrage opportunities. That way, and this is like a key term which you use every time which you do anything in quant finance or derivatives in general. When you say no arbitrage, that means it's just like saying that there are no free lunches. So when I say arbitrage, right, the simplest meaning of the word arbitrage is you're able to generate some kind of a profit without taking any kind of a risk. That's the meaning of the word arbitrage. But in modeling, we assume no arbitrage. That is, we say no free lunches. So that's the meaning of no arbitraging. And options assumed are European in nature. Markets are frictionless, so they allow easy trading of the underlying security as well as the option as well. So these are the basic assumptions which went into the traditional Black-Scholes-Merton model. Now, I will walk you through some basic ideas of the partial differential equation. We'll not solve it today, so don't stress about it. I have kept the main steps which are required. And otherwise, the detailed discussion is something which we do in the live sessions. Also, why we spend time on understanding the PDE and also solving the PDE is because this is a very, very popular question on client discussions and also on many interviews as well. So typically, many investment banks or many consulting firms, they at times have a written round as well, whereby they say, okay, and you studied Black-Scholes-Merton, so then let's do a fill in the blanks. So we'll give you a few steps in the formulation for the PD and can you fill in the blanks, and then we can discuss it in the next round of your interview. So once we work on this, right, it gives us a lot of confidence to work on or applying ETOs for actual asset modeling, which you call as a part of BSM modeling. So that's why we do like a detailed workings of the Black-Scholes PD. We also talk about steps as to how you can go from the PD to the closed form formulas. So for today, we'll keep it very, very light. I promise that in the live sessions, we'll go a lot deeper. So we have a very special portfolio for ourselves today. And our special portfolio, I call it as a pie. And it is a combination of one option and it is long one option and it is short delta number of shares. We'll assume a stock option. Now, when you say long one option, at present, do not bother if it's a call option or a put option. Just take it as an option. It should not matter in this workings for now. So our special portfolio looks like this. Pi is a special portfolio. V is the long position in the option, and this minus delta S is short delta number of shares. Typically, as a convention, anything which is short, you always have a minus sign, which you put in front of it from a cash flow perspective. So we have that short position. And the asset which you are going to follow is going to follow a process like this. Now, for our friends who there may be some of them today who might not have seen something like this. Don't stress. We are going to be understanding this as a part of the module on stochastic processes before we actually come on to the Black-Scholes-Merton. So this is also what we call as a stochastic differential equation, or SDE for short. And I'll just break this up briefly for you. So we have two parts to this. You have something into dt and something into dx. Now, the first part is what we call as the deterministic portion. And the second part is what we call as the stochastic or the random part or random portion. Now, when you say deterministic, it is something which you can know with a certain level of confidence. So here, although I mentioned the mu gets handled, but you can imagine that in place of mu, even if you have R, that's fine. So risk-free rate we know the stock price. dt is our time step. So if you see, everything in the first part is something which we know. In the second part, again, sigma is not a problem, because if you see the earlier assumption, volatility is constant. So we can have sigma as a known, stock price is known. Now, it is this dx part which brings in randomness. And this is also what we call as the GBM, or geometric Brownian motion. Now, what is a Brownian motion? How do you work on that? We will study that in detail in the live session. But for now, just to appreciate why we take this as a process, just imagine for a moment that we are taking only the deterministic part. So if I take a deterministic part, can I say that, let's say if I am at S0 today, if I focus only on the deterministic part and I say that the random part does not exist, then I can have a stock price which grows like this, isn't it? Because it's growing stably at a rate R. But then, do we see a stock price behavior like this? No, isn't it? Stock price behavior actually will show much more wiggles, isn't it? So it will actually be something like this. So this is much more realistic, isn't it? Now, we get these wiggles because we are now incorporating the idea of randomness as well. Because then if everything is deterministic, then we can make a lot of money in very short time. Because if we know exactly how a stock price is going to go, then we can take positions and we'll make money. But then fortunately, that is not possible. And no one can predict that with so much confidence. So then once we combine the random part, we have this blue colored path which comes in, which is much more realistic. And that is what we call as a model for a stock price. Now, how do you break this up and how do you model that? How you can have multiple simulations? That is something which we do together in the live sessions. But just on the face of this, does it make sense, and does everyone appreciate the fact that it is important to incorporate both deterministic and the random portions? Because I reiterate, deterministic will follow this red color trajectory. But once you combine that with the random portion, it will have this blue colored path, which will have all those random wiggles which are there as well. So does everyone appreciate the fact that it's important that we have both of these components as a part of our asset price model, be it equity, be it FX, anything? So does anyone have any complaints in this, that we should or should not have something? Or can I assume that everyone is happy that we require both the components so that we have a much more realistic model? Okay, good. So again, I'm trying to keep it as light on maths today, because then we don't have the foundation knowledge done yet. So we'll keep it light so that everyone benefits from today's demo session. Also, as a part of the working for the PD, right, we take a very small time step. So we take a very small time step of dt. That is, from t, we are trying to go to this one step ahead. That is, think of this as t and think of this as t plus dt. And this is your very small time step. Again, I've shown this as a big time step, otherwise optically it will be difficult to see. But then imagine that this dt is very small. And our aim as a part of the Black-Scholes PD working is to create a portfolio which is riskless over this very, very small time step dt. So that's our aim. We want to ensure that we have removed all the uncertainty when we are working on this very, very small time step dt. That is our target. Yeah. So over a very small time step dt, we try to see how exactly our portfolio value is changing. Remember, our portfolio looks like this. So a very small change in the portfolio value over a time step can be written as like this. D pi equal to dv minus delta into ds. And we assume that over this small time step dt, our delta remains constant. Remember, we are short delta number of shares. So that delta value that we are not changing over this small time step. And that's why if you see, you just have a delta. You don't have a d delta because your delta is remaining constant. Yeah. Now, if you focus on the first term, it can be written this way through the ideas of ethos. Now, again, ethos is something which we study in detail in the live session. So that way, I mean, for now, just think of this as extensions to Taylor series expansions. So, has everyone heard of Taylor series expansions? You might have heard of this as a Maclaurin series. So, do you remember using or maybe studying Taylor series or Maclaurin series earlier? And maybe I can just show you a small inspiration for that. So that, I mean, because the idea is once we have a knowledge of Taylor series, we can do these kind of expansions very, very easily. So can I just take a step back and just show you the inspiration behind Taylor series? Of course, the primer has the details on Taylor series. So maths primer will teach everything. But since we are here together, let me just give you that small inspiration. Okay. So imagine that. So can I just open a new whiteboard? Control N. Does a Control N work? Hang on, a new whiteboard. So I'm just opening a new whiteboard. Yeah. So just to give you an idea of Taylor series, but before I give that idea, right? So for our friends who have studied Taylor series, do you remember why you studied Taylor series? Again, the why part comes in, isn't it? So why Taylor series expansions? What's the purpose? Taylor series or Maclaurin series. You can call any of these. Okay, so I will explain this in very simple terms. So a Taylor series is there in order to understand an approximation in the evolution of a certain function. So that way, let's say I say that I have a function f of x, which is written as e raised to x, simple exponential. Now, if I tell you that, can you show the behavior of this? Everyone says absolutely. Give us an Excel spreadsheet, we'll plug in different values of x, and then you'll say, okay, we have an exponential like function. So let's say you'll have a function which looks like this. Yeah. And this is something which anyone can do, isn't it? We have the different values of x and it's going to be showing an exponential growth. But then this is just a picture, isn't it? And then that's it. What will we do beyond the picture? Not much, isn't it? Because then the picture will restrict us there. But then wouldn't it be fantastic if we are able to have some kind of a mathematical formulation which allows us to understand the behavior of this function? Because once we understand that, we can start applying it for interesting financial assets like equity, FX, and so on. So that ethos expression, which are shown on the slide, that is linked with the idea of Taylor series, because then ethos is just treating Taylor series in a certain manner. So let me just give you a gist of this and how this can work mathematically. So let's say, now I want to replicate this, right? I want to show this mathematically. So I say, okay, let me start with the most simple way of representing this. I say, okay, I represent my e raised to x by a dot. And let's say I write my function as like this, yeah. I say, okay, it's not a bad start, isn't it? I say this dot is my approximation of e raised to x. It's nowhere close to this, but at least it's a good start, isn't it? So then can I say, can I do something better? So then can I, instead of a dot, can I show this as a straight line? That is, can I actually write this as 1 plus x? So think back to your school days. Equation of a straight line is y equal to mx plus c. So I say, okay, this is much better, isn't it? Rather than a dot, now we at least have a straight line approximation. I go one step further and say, okay, there is a curvature which comes in. So can I do something about it? We say, yes, absolutely. So can we have a certain higher order term? That is, can we have, let's say, something like this? That is, now we have a small curvature which comes in. Gradually, we are coming closer to what we are looking for, isn't it? So I say, okay, this is even better because then I can also handle the curvature which is there in the function. I say, can I go further? So can I have, let's say, more higher order terms plus dot, dot, dot. We call it as HOT or higher order terms. So I'll need to know where my stopping point is because then this is an infinite sequence. And then finally, I will be able to replicate the actual this thing. So maybe I use a different color. So finally, as I increase the order or degrees of these polynomials, finally, I will have a function which looks like this, which is very similar to what I had modeled through a simple picture. So this is a simple idea of a Taylor series, or it's called the Taylor series expansion. So does this idea of Taylor series sound okay? And is everyone happy with this? Because then Taylor series is very, very fundamental. Maths primers will get you ready on Taylor series so that once we start applying it for ETOs, you will be very comfortable. So any questions, any thoughts on this? You can apply it for different functions. You might want to use it for, let's say, maybe tonight, if you get time, try to apply it maybe for a sinusoidal function or maybe a cosine function, dot, dot, dot. Maybe a trig function, or maybe you might want to do the same exponential as well. So I would say initially give it a go through Excel. And of course, once you go through the primers, you'll know the mathematical way to do that as well. Yeah, so going back. So this is the idea of Taylor series and we use it extensively. So we apply ETOs and we are trying to understand how DV works. Now, why I say DV works like this? Because then if I move this V to the other side, right? I have this V of S plus ds, T plus dt minus V of st. Because remember, I am looking at a small time step whereby T is changing to T plus dt. And over this very, very small time step, my stock price S is also changing to S plus ds. And that is something which I write here. And on the right hand side, I have the Taylor series expansion. I move this V of st to the other side, and then I'm left with a few terms on the right. If you see, there's a dot, dot, dot. It's an infinite sequence, so we should truncate at a certain point. So where to truncate, etc., will be covered in detail in the live sessions. And as I mentioned, our very, very small time step says that we are working in the limit dt tends to 0. And we make an assumption anything of the order more than dt raised to 1 will equal 0. So we only consider this. Anything like this, dt squared, dt cubed is very, very small. Because remember, dt is very small. So let's say dt is 0.01. Then dt squared is even smaller. Dt cubed is even smaller. So then we can ignore that. And also, as a part of a standard rule, we'll assume that dx squared works as dt. Remember, dx is our change in the Brownian motion. There is a concept called as quadratic variation. We will not be studying quadratic variation today. We don't have that much time. But then we do quadratic variation and then we get on with the ideas of Black-Scholes. So you will know what's quadratic variation. For now, we just assume dx squared can be written as dt. We substitute ds squared. We already know what is ds, isn't it? So we take this and we substitute. And then we finally, so if I say this is my dv, right? This can actually be plugged back in. So if I call this as equation 1, my dv can be plugged back into equation 1. So that way, this becomes the dv portion. And we have minus of delta ds. Now remember what we had set out to do. We wanted to create a portfolio which is riskless over a very, very small time step. So for our friends who have studied options, they will be familiar with delta hedging. For now, don't stress about it. So in case for our friends who have not done delta hedging in the past, don't worry, we will be studying that together. So in order to create a portfolio which is riskless in nature, we make a very specific choice of delta. We choose that as equal to dv by ds. Yes, Bharat, please go ahead.
Is there a difference between riskless and risk-free?
No, I mean, it's one and the same. So you can also call it as risk-free as well, because finally we'll be equating this to a risk-free rate. So technically, they are not different. Yeah, yeah. But a good question. Yeah, thanks, Bharat. And a quick question: something which is risk-free, how much should be the rate of return? So anything which is risk-free in nature, how much return should it give you? Or what should be the return does it give you?
The least.
So Vishal, can I rephrase your answer and say that you will get risk-free rate as the return?
Yes. Yes.
Absolutely. Perfect. Thanks, Vishal. So that way here as well, because I'm saying that our portfolio is riskless or risk-free in nature, it should be eligible to earn only the risk-free rate of return, isn't it? So take a simple example, take a government security. We assume government securities are a good proxy for risk-free rate. I'm just taking the bond as example. So if I'm holding a government bond, all that I can earn is only the return on the government bond, which is risk-free rate. So here also I'm trying to apply similar analogy. Because I have created a portfolio which is risk-less in nature, I should be eligible to earn only the risk-free rate of return and nothing more. And that risk-free rate of return, I call it as a small r. And then I say that I already have this one value for t pi. So I can call this as equation 2. And then I can say my d pi can also be written as r pi dt. Why? Because over a very small time step dt, my portfolio will only increase by the risk-free rate r because it is now a risk-free position. So think of this as equation 3. So we equate equation 2 and equation 3 by after that unique choice of delta equal to dv by ds. And after solving, we come to this equation which we call as the Black-Scholes PDE. So I know we have done like a quick jog through of this, but I promise that in the live sessions we do a much more in-depth analysis. You'll have full clarity as to how this works. And as I mentioned, it's a very popular question on many quant interviews. They want you to have comfort on this. And once you have comfort on this, you can start applying these ethos ideas to other types of assets as well. So we will be doing this in depth. After this, there are a few steps as to how you can get from this on to your final answer. So we'll talk of that subsequently as well. Also, one more technical aspect which I like to talk about today. There is something which we call as a final condition and a boundary condition. So a quick question. So for our friends who might have read about something like this, or maybe I might have worked on PDEs in the past, why do we require a final condition and a boundary condition? Would someone like to give it a go? And then I'll just briefly explain how this works as well. So we have, Kamal, sorry to put you on a spot, but I mean, you're a mathematician, so would you like to give this a go? Okay, so let me give you an idea as to why these are required. Because remember, we have to solve a PDE, isn't it? Now, this is something which you need to solve in a certain manner. Of course, someone may argue we'll do it numerically. I completely respect that. We'll be doing that anyway. But then in order to solve a PDE, right? So here when we go to that numerical analysis, these two conditions become very crucial, a final condition and a boundary condition. Why? Because then we are looking for a specific solution for a PDE. Remember that if you have to solve a PDE, there can be different solutions which you can get for a PDE. But we are looking at something specific. Our aim is to calculate option price. So that's the main target which we are set out to do. And for that, we have to define our specific conditions so that we are getting to a specific answer, which is our option price. So then we have a final condition, which is nothing. So these are also what you call as payoff equations. So if I take you back to the wristwatch example, even without actually calling the word payoff, we had used the payoff for a call option. Remember, we had exercised it in scenario 1 where the current wristwatch price was 150. So imagine max of 150 minus 100. But in scenario 2, when the price was 80, it was max of 80 minus 100 or 0. So it was 0. So at that time, even without calling the word payoff, we had actually used the payoff. Yeah. So we require payoff because then that is unique for each type of an option, whether it's a call or whether it's a put. And we have boundary conditions. So why these bounds are required? Because think of this like a box which you're trying to solve, or like box-like setup. And I just show this as a grid because then it becomes very easy to visualize these things. So take the two axes. So we have 0 to capital T. So this is my time axis and this is the asset axis. If you don't mind, can I just write S subscript infinity? Imagine a very, very large stock price, which I call as S infinity. Now, when you're solving our setup, right, we want to actually work out these three corners of the box. So this corner, and this corner. And for that purpose, in order to address these three corners of the box, so that then we can work on the option price today, which is nothing but this. So I'll just show this through a different color. So the blue colored box which I'm showing, this will help you look up your option price, which is our target. But for that, you see there are three boxes or maybe the three sides of the box which you have to take care of. So the final condition is something which gets taken care by this vertical line right here. So that way, this is something which you apply at payoff. So this standing line is taken care by the final condition. You have the two extremes, isn't it? Because your stock price can go from 0 to infinity. So then you have a condition at S equal to 0 and you have a condition at as S tends to infinity. Because of course I can't say S equal to infinity because no one knows what's infinity. So I can say only S tending to infinity. So then if you see S equal to 0 will address this side of the box and S tending to infinity will address this side of the box. So do we appreciate the fact that after applying one final condition and two boundary conditions, we have been able to work on the three ends of the box so that we are able to then work out a unique solution for our problem, which is option pricing. I know this is a new concept for many of us, but then does it make sense that once we have these conditions in place, we will be able to actually work on the PD? How that can be done, we'll see it systematically in the live sessions. But for now, are you happy with this much? So as a rule of thumb, you can remember that whenever you are working on a PD, you will need to define a final condition and boundary conditions. Without that, you will not achieve the unique solution which you're looking for. Yeah, so how these behave at S equal to 0, S tends to infinity is something which we'll cover subsequently. We don't need this right now. But then I wanted to touch upon these things because then these are very fundamental whenever you have to solve any kind of a PDE or when you're looking for a specific solution. And after you solve, so from the PDE to come to these formulas, there are a few pages of calculation which we study in the live sessions. So generally, if in my experience, if you ask me on interviews, they might want to ask you to work on the PD. Maybe they might ask you to derive the PD or maybe they may give fill in the blanks. But generally from the PD to these formulas, there are multiple pages of calculation which generally an interviewer may not ask you. So we also will not do the entire set of steps, but we'll definitely get an inspiration as to how you can get from this to these formulas. And these are your standard formulas for call and put. And these are standard textbook formulas. I've also shown one whereby you have dividend payments as well. At present, we don't need to worry about dividends. A quick question on ND1 and ND2. So I won't say a question, but maybe a quick discussion because then ND1 and ND2 are again very, very important concepts on interviews. And also, if you see why ND1, ND2, if you look closely, right, there is a presence of ND1 and there's a presence of ND2. So what's ND1, what's ND2, I'll explain in brief. But then you can imagine many times you call this as an N dot as well, which refers to D1 and D2. And this is called as a cumulative distribution function. So a quick question. So for our friends who remember these ideas from probability, why do we work on CDF? Why do we work on a cumulative distribution function? Of course, the primer has this, which you can study subsequently. But then what's the beauty of a CDF? Why do you need a cumulative distribution function? Because there is something which a CDF gives you, which a PDF or a PMF cannot give you. So what's that something which a CDF will directly tell you? So can you jog back your memory to the probabilities class, which you might have taken back in your undergrad or postgrad days? So why we love CDF so much is because it allows us to look up probabilities directly. And that's why we work on CDFs. So if you see ND1, ND2, these are cumulative distribution functions. And they go into these formulas. You have S ND1 minus K into E, X into E raised to minus RT ND2. So I'll just give you a brief idea as to what is ND1 and ND2. So here I've taken the formula for a call option. Is like a closed form solution for a call option. So you have S as the stock price, X as the strike price, R as the, so E raised to minus RT is nothing but the discount factor, and you have ND1 and ND2. Now, generally, when you look at interpretation for ND1 and ND2, which is, by the way, a very popular question for interviews, they will ask you, can you explain us the difference between ND1 and ND2? And also, can you tell us which one is bigger than the other? So these two are like very good questions or very common questions on interviews. So that way, I always insist on discussing a lot of interview questions in all of the sessions, because then there are so many popular questions related to the concepts which you learn that candidates should be aware of that, so that in case you have an interview or a client discussion upcoming, you should be ready with that. So we'll continue to do interview prep throughout the course duration. So for now, just keeping it simple, when you talk of interpreting ND1 and ND2, we are trying to relate this from the idea of exercising the option. So think of that as a given. So we are trying to link these ideas from the ideas of exercising the option. Now we can actually split this equation into two parts for our convenience. Both of these parts are important, so we have to combine them, but then for now, we just split it into two parts. One is payment of exercise price X, which you see in the second part here. Because if it is a minus X, right? And as we know from a cash flow perspective, a minus sign means it's like a cash outflow. So think of it as that way. So I have payment of exercise price, and then there's a receipt of underlying stock. That is, you have a plus S, isn't it? Because then that imaginary plus is there. So we'd like to split this into two parts. Now we'll look at ND2 first. Now ND2 is also an unconditional probability. Today, I'll keep it very simple. I'll not go into the mathematical discussion, but I'll keep it very simple. When I say unconditional probability, that means it is the probability of the strike price getting paid out, i.e., it is linked with the idea of option getting exercised. Because remember, an option will be exercised only if a dealer finds it useful or if it is profitable for them, isn't it? So that way, this probability ND2, because remember ND1 and ND2 are CDFs, and CDFs point to probabilities, and that's why we say ND2 is, now technically we call it as a risk neutral probability. Yeah, so it is a probability that the option will be exercised. Why? Because then if you see, it is related with the payment of exercise price X, and that's why we say ND2 is a risk neutral probability that the option will get exercised. It is the unconditional measure. Now let me connect this with ND1. Now ND1 is something which we call as a conditional probability. I'll explain this simply as well. Now what do we mean by conditional? So remember the two definitions which you must have studied back in probability days. Remember something like this: probability of A and probability of A given B. So this is unconditional, isn't it? Because it's simply the probability of event A happening. And this is conditional. That is, it is the probability of event A happening given that event B has already happened. So that's conditional. So we will try to connect ND1 with the idea of conditional probability. Why? Because remember, this talks about receipt of underlying stock upon option exercise. And when will the option get exercised? An option will get exercised only when it is beneficial to the holder. That is, only when the option is in the money. That is, if it is, so if you take the wristwatch example, scenario one is the place whereby I will like to exercise my option because I am benefiting from that. So we'll think from the idea of exercising the option. And that way, if you think of this from that SND1 term, we are only looking at those scenarios where the stock price is more than the strike price. Why? Remember the payoff condition of a call option, max of S minus X or 0. So X is just the strike price. Earlier I had called it as K, today I'm calling it as X, but then it's the same thing. Yeah. So in this case, my option is valuable only when stock price is higher than the strike price. That is, S has to be higher than X. If it is lower than X, it beats the purpose. Then my option is not profitable for me. I will not exercise the option. So for ND1 calculation, we only take those scenarios where the stock price at expiry is greater than the strike price. So why? Because remember, we are trying to connect this with the idea of exercising the option. An option will get exercised only when the stock price is greater than the strike price. Otherwise, it will not get exercised. And for that purpose, we'll only take those scenarios whereby stock price is higher than the strike price. All the places whereby ST is less than X, we will ignore. That is not of interest to us. And that's why we can think of this as a conditional probability. That is, it is conditioning on the fact that we are only taking those scenarios whereby stock price is greater than the strike price. Yeah. And that way, ND1 becomes a conditional probability. So here I've given how you can interpret the final conclusion of the VSM formula as well. But then a quick question, which is very common. Which one should be bigger? ND1 should be bigger than ND2, or ND2 should be bigger than ND1? And for this, even without Black-Scholes-Merton as well, you should be able to answer. So just remember that ND1 is a conditional probability. ND2 is an unconditional probability. So then which one do you think is correct? Feel free to give it a go. Okay, so ND1 is bigger than ND2. I'll tell you why. I'll take a very simple example. So let's say I take a fair six-sided die. And if I want to calculate, let's say, probability of getting a 5, then for a fair six-sided die, I have the probability which is 1/6, isn't it? Yeah. This is unconditional. Now, let's say I have additional information and I am told that what is the probability of getting a 5 given that the toss is always going to be more than 3. So then I get a 1/3, isn't it? Because then now there are only 3 outcomes to consider. I don't need to worry about the rest. So that way, ND1 is bigger than ND2. That is, your conditional probability is bigger than the unconditional probability. You can also use this simple example for an interview also. And applications of Black-Scholes, many. It's a very popular model which you use for daily option valuation. We use it for constructing wall smiles, wall surfaces. We use it for capital charge calculations. We use it for regulatory monitoring and reporting plus MIS reporting as well. And many advanced option pricing models take their inspiration from BSN. So that way, that's why I prefer calling that as a framework. It is very powerful and robust. We'll talk of numerical methods in detail. So I've just mentioned here for our reference. I know I'd mentioned these 3 as a part of the earlier discussion as well, but then details of this will be covered as a part of our live sessions. And numerical methods are very important important part of the course in general, I would say. So that way, I mean, this is like a quick overview of the program as well. So I've made a small pictorial which gives all of the things in one go. And of course, I mean, this completes our discussion on Black-Scholes-Merton for today. So any queries, any questions which you have on today's class? So that way, even the live sessions, we'll be doing a lot of interactions. I ask a lot of questions in class as well. And I always insist that candidates should ask a lot of questions, because then, to be honest, a question is a question. Whether it's a small question or a big question, it does not matter. And feel free to ask n number of times. I'll answer it n+1 number of times. But then conceptual clarity is very important, and we'll always insist that everyone understands things. Of course, today I understand that we are not gone in depth into the maths, because then for a demo, of course, we don't have the required background to get into the maths part. So we have kept it very maths light. But then the idea was to give you a flavor of how actual classroom happens. And we'll solve a lot of applied maths together. And to be honest, it's all applied maths. It's not pure maths. And applied maths is very interesting, because then that is something which we extensively use in the industry. So any thoughts, any questions, either about today's class or about the program, which you would want me to answer? I'll be happy to do that. you can also visit the course page as well later on to go through further on the course, and or you can just scan the QR code and this will take you to the same course page as well. So if you love the course, and you can join in directly from the course page as well, and that way, I mean, the primers are already ready, so you can begin studying them. So I hope you guys enjoyed the session today. I really enjoyed interacting with everyone. So thanks for joining in. Thanks for keeping it interactive. And I look forward to having you as our candidates for the upcoming QRFP cohort, which begins from 18th of July. So any thoughts, any questions before we sign out for the day? There's a question to go. Yes, certainly, Ramakrishna. We definitely talk about the current events which are happening in the market as well, because I think that is very important. So any important developments which happen in the market, we try to cover it in the sessions. Yes. And also, just to add, Ramakrishna, to your question, what I attempt to do is, in case there is a new concept which has come up, let's say during the once we started the course, and let's say it's not mentioned in the course file, what we try to do is we try to cover it towards the end. So in case there is a very important aspect of, let's say, AI, or maybe important aspect on modeling which has come in, we try to cover it extra in the end. So then I request candidates that, okay, I mean, once we complete the entire curriculum, we'll do something extra. So then I request people to join in one additional weekend, and we try to cover that as well. So we stay very, very close to the market, because then this program is for the practitioner and you should be able to apply these things directly in practice. So we'll definitely do that. Yes. Any more questions? Okay. All right. Great. So thank you so much. Thanks for joining in. Really appreciate it. And feel free to get in touch in case you have any more questions, queries. I'll be happy to answer them. And we still have some time, so we'll begin from 18th of July. You can join in anytime, and we look forward to having every one of you as our course participants. I think we'll have great classroom discussions. So I mean, me, Date sir, Lakshmi, we do a lot of interaction, because I think that's the best way for everyone to learn. And many times it happens that your question can be someone else's question as well. So I always insist candidates that please keep asking questions, because then at times it happens that we might have studied a certain concept in the past, but then if we again revisit it, that is something which gives us further clarity on things as well. So then everyone benefits. So let's keep it interactive, and it's a very interesting subject to learn as well, and we'll learn it systematically together. It is not difficult once we learn it in a systematic manner, and the QRFP program will ensure that you learn it in a systematic way. Great. So thank you so much. Thanks for joining in, and wish you a good evening, and also wish you a good Sunday ahead. And yeah, let's keep in touch. Thank you so much. Thank you. Thank you. Yeah. Bye-bye.
Thank you.
Thank you so much.